Sridhar Shivram, Executive Director with Morgan Stanley Investment Management, joins us live now. Sridhar, morning. Fantastic to have you back. Sridhar, whichever way I look and cut and dissect, things are looking slightly challenging. Sentiment is bad. Earnings have been downgraded, and apart from monsoon, there are no growth triggers in the short term.
Yeah, I would tend to agree with you. And if we look at what Reserve Bank is also trying to do, at this stage the priority is really the currency. And anyway, we know that growth is slowing down, GDP numbers are getting downgraded by the day. We would expect the GDP number closer to be around 5%. So I would agree with you. So things are looking challenging, but they're looking challenging not only for us, for the entire emerging market basket. So to that extent, we're not the only ones.
But along with adversity, opportunity always comes together. So at the current juncture, where is opportunity in this market?
Well, opportunities are far and few. So one is really looking to, protect capital more than trying to really look at opportunities which can be multi-baggers. Maybe a few here and there. I can think of IT as an opportunity, some pharmaceutical opportunity, telecom, as you mentioned, some results came which were very good yesterday. So the opportunities are far and few, but yeah, it is challenging times.
Sridhar, so what do you make first of the macro picture? And I mean, you must have heard the finance minister as well day before. Does it seem like the RBI and the government's tools to help lift the rupee up are going to work? And more importantly, are we going to be able to bridge the fiscal deficit gap as well and actually maintain the growth targets that have been set off in the macroeconomic report this time?
So growth is surely slowing down. I mean, you look at the results that are coming, I mean, you can clearly make out. So the GDP numbers from 6+ are constantly getting downgraded. So the growth is really a challenge, and we know most of the issues. I mean, the government has tried to do some bit of reform, but the follow-through has been poor. So to that extent, these are challenging times. Now, in such a scenario, is it possible for the government to meet the fiscal targets? Will it be able to, contain the depreciation on currency? Things look difficult. So they may need to do multiple steps, and they may need to do it, in regular intervals for these to be contained. So to that extent, things are not looking that great as we speak right now. But as I said, the currency issues are there with a lot of other emerging markets also. And we've seen a lot of the central bankers, including, say, in Turkey, in South Africa, in Brazil, in Indonesia, they've raised rates. So maybe in hindsight, the Reserve Bank could have just gone ahead and raised rates rather than trying such a roundabout way. But whatever it is, tightening has been there in many other countries. And many central bankers are fighting the currency battle right now. And growth is really not at the forefront right now.
And that seems to be the fear, right, Sridhar? Because we've seen a couple of PSU as well as private banks come in and hike their base rates after a status quo policy from the RBI. And most market men do tend to fear that perhaps this is the, turn in the rate cycle, and we are going to see an increase in deposit rates. More importantly, the investment climate, because the normal layman in the street is only going to shift to FDs, hence pulling out from equities.
Yeah, this is surely a change in the rate cycle, whether central banker or the government want to admit or not. But rates, be it short end, long end, liquidity, everything is tight. And as we've seen from some of the commentary from the central banker, that if this does not work, they will continue this for as long as it is required. And this will be tapered off only in a calibrated manner. So surely the cycle has turned, and as I said, currently the battle is to contain the depreciation of the currency. And so the risk is that surely growth is going to slow down, which is why we are seeing some nervousness in the market as far as some of the sectors or companies which are highly indebted, that some of the only reasons that you could have argued that they will come out of their problem is if the growth really accelerates. But now you're talking of growth slowing down. So the probability of NPA becomes that much higher, which is why we are seeing banking stocks also under pressure. That one, if the rate cycle turns, number two, if growth slows down, and we know that there is a fairly large number of companies who have been restructured. There's a probability that they become NPA, in 6 or 12 months' time. So, which is why the nervousness in financials. So, one has to be cautious at this point of time and see how things play out.
Financial technologies, it's down 30% today. It was down 64%. So if you look at the absolute fall in a matter of just 2 trading sessions, 34% down now. If a stock falls 100%, it's actually zero. I mean, the price damage is really severe here because the exchange has broken trust and they have deferred a payout. MCX has fallen 20%, it had fallen 20%. That's the 6-month chart for you, a hit of 88% there. Financial technologies, that was the big story yesterday, and that is the big story today as well. Sridhar, in the past when we've interacted with you on this forum, you maintained a view that you are bullish on private sector banks. Given the way how macros are moving and the fact that interest rates are unlikely to come down, are you rethinking your exposure to private banks also?
So we've been very selective on the private banks that we have. In such a challenging situation, it's not possible for these private banks also to hold on. But keep in mind that we are long-only investors. We have a benchmark to look at, and financials are about 28-30% of the benchmark. We've been underweight financials through the year, so to that extent it has benefited us. But to say that when there are such challenging times, even the best of financials will not come down will be foolish. So yeah, so from our positioning standpoint, we're not changing our positions right now. We are reasonably fine with the banks that we own, and we look at it as things go forward.
Sridhar, what about the outperforming lot in the market, FMCG and IT? Is it time to take money off the table, or do you think there's more to the froth?
Well, we are currently underweight FMCG. We've run an overweight FMCG for a very long time. So our philosophy is we don't mind paying, for growth. But if growth itself slows down, as we are seeing with most of the FMCG results, then we don't see any reason to, pay such, huge multiples. So we are currently underweight the FMCG pack. Which was the other sector you said?
Sridhar, I was talking about IT.
IT, yeah. IT we are overweight. So we like the sector. We've been overweight from the beginning of the year. But yeah, there are challenges to the IT sector, and the biggest one, which is well documented and written, is about the immigration bill. And one of the big concerns with the immigration bill is the fact that this bill, the way it is drafted today, it doesn't apply to the US companies, which is an IBM or an Accenture. And some of the US companies like, Microsoft, be it Google, have openly come and supported the bill. So the concern is, does the Indian IT companies and Ascom have enough lobbying power to, get this bill through in such a manner that it is in favor of them? So I think there are some headwinds for the IT sector, but the way it is currently, we are overweight.
Sridhar, I've never heard you that bearish. I've been interacting with you for over 8-10 years now. Every time I've interacted with you, you've used words like hope and recovery. Now you're using words like challenge and slowdown.
Well, those are the realities of life. So what we are seeing right now is what I'm talking about. Keep in mind that we have an election coming up in a year's time. So we know that, maybe in another 6 months' time, a lot of the policies would be, aimed towards the electorate, the election-related spending. So the window for the government to do anything significant is only in the next 3-4 months. And I wonder how much they will be able to do. So if I keep those as a backdrop, things do look challenging. So as I said, it is challenging across emerging markets, which is why we've seen that FIIs have still put substantial amount of money, even net of some of the outflows that we've seen. We still got about $12-13 billion this year. That is obviously because there are a lot of other challenges in other emerging markets too. So I guess it's a relative thing right now. So to that, I mean, in the emerging market, we are still overweight India. So if that says anything.
Are you looking at picking something from the wreck of infra, metals or PSU banks, or those stocks, those groups and those names are an absolute no-no?
Well, commodities we are bearish because we are underweight China. We are not very bullish on commodities as a basket. I'm not an expert on commodities, so I use the expertise of my emerging markets team. On the infra piece, we still remain very bearish. They over-leveraged balance sheet, and as I said, the only hope for them was growth comes back. But now we know very clearly that RBI is fighting the currency battle. Growth is not the most important factor here. So we'll see growth slowing down. In such a scenario, it's very difficult to see that these companies can, really come out of some of their problems. So to that extent, financials are also a worry, especially the financials who have high exposure to some of these companies. So I wouldn't look at, bottom fishing in any of these.
So in that light, would autos as well be an avoid, considering the interest rate scenario right now, as well as the demand slump, which seems to be pretty clear with the monthly sales data?
Yeah, so we've been underweight autos right from the beginning of the year. So the cliche in the beginning of the year was interest rates are coming down, buy financials, buy autos. But if you go back in history and check what happened to some of these sectors, interest rates have had no play at all. So you go back between 03 and 07, where we've had a cycle of falling interest rates in the beginning and rising interest rates later on. Financials did reasonably well. 2008 financials did badly. 2010, when inflation was 10%, interest rates were going up, financials did extremely well. And we know last year, in 2011, financials didn't do well. So all I'm trying to say is that interest rates, based on the data that we have no role to play as far as performance of the sector is concerned. What is most important is the NPA situation. And for the autos, it is the sales number itself. We did not see either of them improving, so we were underweight both the sectors. We still remain underweight. Even for autos, we don't see the numbers turning at all. So until and unless the sales number doesn't improve, it's very difficult to buy, because currency is a benefit for some stocks, or there's a hope that recovery will come the next year. Things are looking tough. So maybe it's a hiding place for some people, but we will try and look for other hiding places and not autos.
The only conviction buy has been IT. That's the only one that you're bullish on. What else are you liking right now?
There are some opportunities in the pharmaceutical space. So there are some opportunities in telecom, which was really a hated sector a year back. So now people are, looking at that very seriously. So if the ARPMs can go up from whatever 40 odd paise to maybe even a 10 paise from here, that's a significant jump in the earnings. So there are some pockets available. So these are challenging times for fund managers also. So even though I may look as if I'm very wise, I am sure I have enough stocks in my portfolio which are not doing well. So I guess it's hindsight is always easy to say.
Okay, Sridhar, I'm going to let you go on that note, and thanks for that very candid chat.